I mean, remember, back in 2022, Jeff, I was one of those people that was arguing that we weren't going to have a recession in 2023. The reason I believed that was because I said labor markets were fine, housing stocks were outperforming, and the Fed was backing off because, inflation was starting to come down. Fast forward to today, labor markets are cooling by Powell's own admission, right? He listed a litany of indicators talking about how the labor markets are cooling. I mean, it was a bit of a garbled mess, but he said that labor markets are still cooling. The Fed is dialing back rate cuts. And, just pull up a chart of home building stocks. Yep. It does not look very encouraging. So, and unlike then, right now, no one thinks there's a recession. Everyone's very sanguine on growth. I'm not saying I think recession is likely, but you can't rule out some kind of a growth scare early next year. So I wonder to some extent, did the Fed's actions in December actually make it more likely that they'll be cutting more than twice? Did it make it more likely that they'll be cutting in, March? It seems kind of counterintuitive, but I think, there's something to it.
Welcome to RenMac Off Script. We're able to discuss markets, economics, policy, history, and life. It is Thursday, the 19th in the evening. I am Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We're going to touch on what's going on in Washington. Obviously, there's some late-breaking developments, so making sure we timestamp that. Talk about Powell this week and the split he threw in the bowling lanes, if you will, of the markets, and we'll get right into markets. What's going on with factors and sentiment and credit and yields and the like. But let me ask a question first. Does anybody know if Santa had a baby, what would they call him? Subordinate clause. All right, little legal. All right, yeah.
Someone's the son of an English teacher, I guess. I mean,
thumbs down from Pavlik of all people, for God's sake. That must be bad. All right, so let's get things started. Late breaking news here this evening out of Washington. Steve, tell us what you know and what the implications might be.
Sure. I mean, depending on when you're listening, these things may have changed, but Thursday evening, a little after 4:30, it looks like Republicans have a framework. It looks remarkably similar to the earlier iteration regarding legislative package. So you have a stopgap until March 14th to avoid a government shutdown ahead of the Friday deadline, health extenders package without the provision for pharmacy benefit managers, no ethanol, no outbound investment. A lot of those other miscellaneous policy riders are now out. And most of the disaster relief is now in. That's similar to the package before. The other big addition is suspending the debt limit for 2 years. So it looks like Republicans in the House, at least, are sort of coalescing behind this. President-elect Trump has come out in favor, which should help the vote margin there for Republicans. Remains to be seen whether or not Democrats will get behind this. And at this point, if it is able to clear the House, my guess is it would probably clear the Senate. We're going to, at some point, I'm still very skeptical that we're going to enter a government shutdown. And while it may get into it this weekend, I'm applying it more from Monday. That's when you would actually have the effect. And it wouldn't surprise me if we haven't resolved this by the weekend, to at least do some sort of short-term extension, literally just to, hey, let's live to fight another day. Don't want the optics of troops not getting paid around Christmas and the like. So I'm hoping that cooler heads will prevail. I'm hoping that deal just gets done, just when I stop talking about this. But that's sort of been the big news, just breaking now. And then you sort of think about, what does this mean moving forward? It's not a good look for Speaker Johnson. You have to remember that when Congress reconvenes January 3rd, the first thing he's going to have to do is be elected Speaker of the House. That's going to require a majority. I'll sort of remember the multiple rounds it took Kevin McCarthy. Obviously, didn't last in the role. Will there be any lessons learned? Do House Republicans want to repeat this situation? Does President-elect Trump just sort of come out and back Johnson to sort of prevent a repeat of that situation? I think that's probably the thing to keep an eye on between now and January 3rd, assuming everything shakes out this weekend.
So what do you think the ultimate goal of this was? And let me throw two ideas out there. One, I believe this was started by Elon, correct? I mean, it wasn't really Trump who did it. So was this kind of like, okay, let's just let's just nip this in the bud. And by the way, I'm president, not you, man. So let's tap the brakes there. Was he trying to gain leverage? And if so, what leverage is he trying to gain, and did it work?
Well, you're right to point out the sequencing. It should be lost that, Musk was the one that really was the first one to come out very critical of this bill, and that you really saw Republicans who were probably more fearful, candidly, of his vast fortune that could fund potential primary opponents, sort of share a similar view to him, and Trump was a little late to the game. So I don't know that they were necessarily coordinated there. That's going to be important to watch moving forward. Does Musk overstay his welcome here in Mar-a-Lago and potentially at the White House? But in terms of Trump's desire here, I think if we go into a government shutdown, there's a case to be made that he sort of stops Biden from spending some of the remaining Inflation Reduction Act funds, keep the Treasury Department and Energy Department from doing some of these midnight regulations and some of these provisions regarding eligibility for EV credits and the like. So, I mean, there's a sort of a 4D chest argument that that's really driving this. It's also possible that Trump sort of became aware. I don't know why he wasn't made aware of this earlier, of the idea that, hey, the debt limit suspension expires on New Year's Day, and I don't really want to deal with this next year. And so maybe that's sort of, hey, if I just sort of insert myself in here now, maybe I can get something that I'd prefer not to deal with. So take your pick. But I think that's,
Right.
if I had to offer an explanation, that's sort of what I would
Well,
think.
between that and Powell, which we're going to get to, obviously the market has reacted to that. Keep in mind going into this, and we've been highlighting this with clients, that we had beta performance, 65-day beta performance was in the 99th percentile. That has cooled a bit, but not a ton. It's down into the 92nd percentile. In other words, beta had really very rarely, only about 1% of the time over the last 25 years, performed better between high versus low beta. So that was important. And then value, right? So essentially, some of the beaten down cheap stuff had been underperforming, really pretty dramatically. And our sense, just historically looking at that was setting up for some type of mean reversion trade. Granted, we thought that would be early 2025, not right here. Still in that camp. I think this is noisy. The good news is that 20-day lows spiked. We had almost 11% of the S&P 500 in what we call negative volatility alerts. These are kind of statistically significant moves to the downside. They usually are exhaustive, and we've now got the S&P, not the NDX, but the S&P in an oversold condition, setting up for the last 2 weeks of December, which historically are consistently two of the strongest weeks in the year, outside of July, which we talked about last July, how strong those tend to be. So we'll get back to this because there's a few other things I want to talk to. But Neil, I want to turn it over to you in terms of Powell, what he said. I think it surprised a lot of people. What your reaction to that is, and frankly, how much of it on a percentage basis do you think was politics and kind of setting the mood versus, really kind of central bank speak?
I mean, I'm hard pressed to argue that anything other than most of it was politics, because I think if you were to be honest about the data as it's coming in, the revision to the Fed's 2025 core inflation forecast is quite dramatic based on the data that's been coming in, and frankly, based on the changes to the other areas of their projections, right? I mean, if you have, they revised up real GDP by 1/10 of a percentage point. They revised down unemployment by 1/10 of a percentage point, and they revised up PCE inflation by 4/10 of a percentage point, and core inflation by 3/10 of a percentage point. So, in other words, the magnitude of the inflation adjustment is disproportionate in any sort of workhorse macroeconomic model relative to the changes in growth and unemployment. So, clearly something else is going on. And if you look through the rest of the document that was released yesterday with the Fed meeting, it's the risk assessment, right? I mean, before in September, most of the participants saw the risks as broadly balanced to inflation. And now an overwhelming majority, I mean, I think it's like 16 of them, see the risks as skewed to the upside. So this is clearly they're prejudging policy outcomes. That's what this is. They can say they're not, but they are. And in fact, Powell admitted that some of them already are. And that's a fairly remarkable turnaround from what we saw with the Fed meeting immediately following the election in November, right? They talked about we don't prejudge, we don't speculate. And now they've basically said otherwise inside of 6 weeks. And, you can argue that confrontation with the Trump administration was inevitable, but I think it's also arguable that the Fed is inviting additional confrontation with what they did. Nothing has happened yet. And at the same time, and I'm sure you'll speak to this, did the Fed really cut in December based on what we see in the markets? Stocks sank, yields surged, the dollar has exploded higher. And, I think the outlook, as listeners and readers of our work know, we thought the outlook for the economy was deteriorating even before the Fed's decision. I think it obviously means that it's continuing to deteriorate after the Fed's decision. But if you, just go down the list, the housing market, it's lights out. Okay? Lights out for housing. You can say that it's hard for something to go even lower once it's on the floor. But look, at the end of the day, there's still more downside to construction. That's about half of residential investment. And new home sales will probably slow down. And this is a fairly dramatic difference. Rember, back in 2022, Jeff, I was one of those people that was arguing that we weren't going to have a recession in 2023. The reason I believed that was because I said labor markets were fine, housing stocks were outperforming, and the Fed was backing off because, inflation was starting to come down. Fast forward to today, labor markets are cooling by Powell's own admission, right? He listed a litany of indicators talking about how the labor markets are cooling. It was a bit of a garbled mess, but he said that labor markets are still cooling. The Fed is dialing back rate cuts. And, just pull up a chart of home building stocks. Yep. It does not look very encouraging. So, and unlike then, right now, no one thinks there's a recession. Everyone's very sanguine on growth. I'm not saying I think recession is likely, but you can't rule out some kind of a growth scare early next year. So I wonder to some extent, did the Fed's actions in December actually make it more likely that they'll be cutting more than twice? Did it make it more likely that they'll be cutting in, March? It seems kind of counterintuitive, but I think, there's something to it. And yeah, I'm concerned. I think it's hard to argue otherwise. The dollar strength, I think, is something that's going to get more attention going forward. Obviously, it's not just, our friends to the north in Canada. And if you're, living in upstate New York, New Hampshire, Washington, you might as well drive across the border and go shopping, get those last minute gifts in. But between Canada, the emerging market, and in particular the emerging market complex, right? That's what's concerning, because those countries in the emerging markets, they have lots of dollar denominated debts, right? So the strength in the dollar, as a result, is going to tighten up their financial conditions, which will weigh on global economic growth, which will in turn weigh on U.S. export activity. And believe it or not, exports have been adding roughly half a percentage point to U.S. GDP growth over the last year. Do you think that's going to continue over the next couple of quarters? I'll take the under. So, I think it's sort of a mess right now. I think it's unfortunate. And I think the Fed goofed.
Yeah, well, look,
I just want someone to get up on Twitter or Truth Social and just start tweeting out "Feel the market" in all caps.
Yeah. Yeah. Leafs game, anyone? Time to go to the Leafs game, huh? Yeah. All right, eh? Look, I think that's exactly right. And when you look at the strength of the dollar, what you have to ask is, are we creating the ingredients or the recipe for some type of international crisis in balance of payments and the like, right? Because this is a pretty meaningful move, and these moves have consequences. One of the only areas of the markets that's not regulated and kind of swings around as it needs to keep equilibrium in place are the currency markets. And so when you start getting big volatility in currency markets, it really is a reflection of off-kiltered policies, both on the fiscal and monetary side. And I think that's absolutely critical in terms of the way policymakers need to think about this. The other question I would just have for you, Neil, is when we look at other global central banks, I mean, this is not the time that they really need to be seeing, this tailwind from other global economies. I mean, clearly other central banks are cutting. So it's not that they're cutting because their economies are so strong, and they're looking to consume. They're cutting because things are generally softer. So what do you think that play is? How do you think that reacts? I mean, clearly they did not respond as well as we did to COVID or out of COVID. It's been a little bit more lethargic. It's been okay, but it's been more lethargic. And now we seem to be on the other side of that hill. How much is that going to play into maybe the Fed missing this, that globally things are softer than they were, say, 6 or 12 months ago, and they're not taking that into account?
Well, remember, currencies move for basically some combination of four things, right? Growth in the US, growth outside the US, policy in the US, policy outside the US. That's why currency markets largely move the way they do. And what you have right now is a belief that the U.S. has seen strong growth, although I have some doubt about that recently. I mean, we have seen data surprises come down. I think the latest move in the foreign exchange market is largely about a hawkish or tougher Fed, and at the same time, you have global central banks easing. I mean, Bank of Canada came out with a jumbo cut. BOE sort of a dovish hold. We know the ECB is likely to ease or continue easing. We had Mexico today easing. So if you have the Fed on hold and the rest of the world still cutting, it's going to put upward pressure on the dollar. Very simple. And I mean that's going to create challenge. I think. I mean, it's been quite surprising, frankly, that we've generally had a fairly strong dollar environment and we haven't had some kind of balance of payments problem in EM. Maybe that speaks to the orderly nature of the dollar's rise, but to your point, I mean, we're up about 7 or 8% in the broad dollar index, I think, over a period of a few weeks, and so that's a pretty remarkable move for foreign
That's a
exchange.
lot. I mean, just for people that aren't familiar with financial markets, that's a lot. That's a big deal. But look, those four factors that you pointed out, right, as a good economist should. The one that's dominant in that is the interest rate differentials, right? I mean,
Sure.
you can stuff the other three into maybe 10% attribution for the dollar, but it certainly is interest rate differentials that tend to drive it, which are also linked obviously to growth differentials as well. Do you think there's any chance? I know this isn't a terribly busy policy time or Fed speak time. Any chance that they sort of recognize this and walk it back with any of the other governors that are speaking between now and the end of the year?
Well, we have New York Fed President Williams. I think he's talking on a TV interview, I believe next week. We also have Mary Daly. I mean, I'm not really sure how much they're going to be able to walk back anything. I mean, yeah. So they're talking tomorrow meaning on Friday. They're both appearing on interviews, but really it looks like they're going to be phoning it in. I mean, through the end of the year. So I don't really expect much. And they wouldn't be the ones that would be the ones to communicate like some kind of a walk back. I mean,
Right.
Mary Daly, she's the San Francisco Fed president. Maybe Williams will say something, but he hasn't really been a useful source of any information during his tenure at the New York Fed. So, I'm not really expecting much out of either of them. This
So let's
was
just we'll keep Jay out of the eggnog. That's what we got to do. Keep Jay out of the eggnog between now and the end of the year, and maybe things will settle down.
I have to, this is giving me very much like 2018 vibes. We're a
Okay.
long way from neutral.
Right.
And like I said, one more month, then we'll start getting the feel the market tweets.
So, one of the problems, if you will, with the equity market, unlike where we were a year ago, and this is important, is where is sentiment? One of the things that we watch, and we always want to be careful with this. We don't like throwing stones at friends and colleagues, but there is a certain herding behavior that takes place in the street. Part of that is that strategists, unfortunately, don't tend to be terribly prescient when it comes to forecasting the accurately forecasting the future of the S&P. One of the things, and we've got it up here on the chart, is looking at just the 12-month change in S&P forecasts from strategists, right? Where they were a year ago and where they are today and what that percentage change looks like. And there's several strategists from all the major houses here. Essentially, this month, we've seen the highest 12-month percent change in strategist forecasts ever. And this goes back about 25 years. So in other words, they were woefully below their forecasts were woefully below the current spot price of the market. Market got away from them for the entirety, really, of most of 23 and all of 24. And just now are they starting to catch up. And so they've really had to essentially capitulate. They've taken their forecasts up to a point where even the bears now have a bullish bias. And the question that you have to ask, and why this is important, something similar happened back in 2021. You saw these guys capitulate, and then within a couple months, the market made its peak in the fall. The question and why this is important is that if you don't have that wall of worry, if everybody's bullish, that means people are most likely already committed, and then you have to ask yourself, where's the incremental capital come from, right? So who's the incremental buyer? Who's selling bonds? Who's taking money from cash and reallocating it to equities? And again, this isn't a precision type of indicator. This is more of a ballpark or zip code indicator, but certainly is something that is much different than where we were last year in terms of how the strategists and generally the street is thinking about the S&P for 2025. I would say that, where we are is more consistent with our market cycle clock. What we're seeing there is, essentially something that would ascribe to about a 15% return for the S&P. I think actually we have a softness in the first quarter that sets up more bullishly. We'll use that oversold condition to then set up into the remainder of the year. Right now, we are getting some pretty interesting optimal entries. One of the things I like about these optimal entries, these are oversold conditions and uptrends, but they're taking place in relatively call it mid-tier beta to low beta, and also more value type of names. And that's in banks and insurance, a lot of optimal entries in both banks and insurance. And the reason that I think that that's important and buyable is that when we look at the credit markets outside yields going up, we're not seeing any dislocation in credit spreads. We're not seeing any type of dislocation that would be otherwise an indication of recession, which I think is historically generally good news. Steve, any insight on Syria and kind of this power vacuum that's there? I have a soft spot in my heart for chaos. Anything that stands out in terms of what the next moves are and who the play?
Not really, just sort of watching the U.S. support there for the Kurds. It looks like Russia has reportedly moved some of their weaponry out. I believe it sent it over to Libya. So, I think there's still a lot to be determined there. And yeah, it's going to be another issue on the geopolitical front that the incoming Trump administration is going to have to deal with.
How much do we back the Turks as our proxy to kind of take the place over? But, secretly we're maybe not so secretly, obviously backing them, helping them, and looking at that as a source of stability. And would it be stabilizing long term, or is that a problem?
The situation with Turkey is complicated in the sense that Erdogan has a lot of friends sometimes with unsavory characters, but something can be beneficial as a back channel. The Kurds have been good fighters for the U.S. in terms of rooting out ISIS and the like, but Erdogan does not like them. So that's sort of where maybe our interests diverge a little bit. So sort of seeing what that governing regime is going to look like moving forward is going to be important. But I believe Erdogan and Turkey were sort of behind HTS and the overthrow of Assad. But again, what does that mean for the Kurdish portion there of Syria? I think that's going to be something to watch. And whether Trump wants to get involved, my guess is probably not. And perhaps Erdogan sees an opportunity. So something to keep an eye on.
Yeah. Neil, what do you have for data next week?
Well, there's really not much going on, obviously, given the Christmas Day holiday, but I'll be keeping a close eye on new home sales. That's a November data point. The housing market's been a complete mess, and the new home sales data has been showing increasing slack in the single family market. So when you look at completed units for sale, they're up about 50% against last year. They're up about 40% from where they were before the pandemic, and that's going to likely weigh on single-family construction. The earnings reports out of some of the major home builders haven't been particularly encouraging, and so I think new home sales in particular, are going to be softening going forward. And right now the consensus has an upside move in new home sales. We'll see if that actually happens, but I think generally speaking, the trend for housing is lower.
Well, we'll be watching these key levels in the S&P. We're right at the 50-day moving average right now. 5,700 has been basically the last support level. Again, we had that spike in 20-day lows, which usually is very close to some type of peak interim capitulation. So that's important. We'll also see how these oversold conditions hold. They should hold within days. That's usually why they are so important, because there's such a timeliness to those names. And then we'll continue to watch credit, right? So the credit spreads important there, meaning remaining quiescent will be key to at least starting out the new year in a favorable fashion. Steve, what's happening in Washington? I know it's very fluid right now, but what are some of the main things that you'll be watching here over the next week?
Well, hopefully, there's not going to be much to watch. Lawmakers will resolve this. The government won't shut down. If not, then I think we'll sort of be watching Monday whether or not they will do some sort of continuing resolution, just get through this, or have a temporary shutdown to try to get this resolved before Christmas. Just remember that a government shutdown is a lot different than a debt limit default. I don't want people to equate the two, because sometimes now when they both come up in this legislative package, that tends to happen. Government shutdowns, unfortunately, have become more frequent. They tend to be shorter in duration. Markets tend to look through them, dismiss it for political brinksmanship, because it's essentially what it is. Obviously, a prolonged shutdown could be more problematic, and there's also the question of, just because you shut it down, what do you need politically to reopen it? But I don't think we're going to get there. Versus debt limit default would be unprecedented and much more catastrophic, both economically and I think for financial markets. Again, most of the economic impact from shutdowns is short-lived. Government workers get their pay sort of backdated. So I guess that was just an important distinction I would make. And then if that's the case, then hopefully we're not dealing with anything until January 3rd.
Well, it's an important distinction. Thank you for bringing that up. Just from a calendar perspective, the three losers of us on this call have nothing better to do next Friday, so we will give you this podcast as well, and we'll see what kind of really exciting things happen over the Christmas week. But it's hard to say. So that's our little calendar update, and we want to wish everybody obviously a safe, enjoyable holidays as we kick into that, and you can join us again next week when we will be 1 week older, 1 week wiser. And don't forget us to follow us on Twitter and our YouTube channel for subscribers. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
He's on mute.
And that's Steve
Go this
Pavlik.
way.
And I'm Steve Pavlik. Sorry.
We go the whole year without you
I've
screwing
been
it up,
good.
and you do it the first time. All right,
No,
one more. Are you ready? One
Hey,
more.
Jeff, Trump won the election, so we can say Merry Christmas again. So
Okay, fair enough, if you'd like. Why shouldn't you lend money to elves? Because they're always short. All right, that's it. Merry Christmas.
Wait, do the ending again.
No, we're keeping the ending. That was great.
Okay,
Yeah.
good. All right. Good job, guys.
Later, guys.
Yeah.
Yes.
Bye.
take care.